While millions of investors spend thousands of hours chasing hot stocks, timing the market, and trying to beat the system, you're about to learn a strategy so simple it almost feels like a cheat code. We're going to build a portfolio using just 3 exchange-traded funds, or ETFs, that has consistently beaten the vast majority of investors, including the pros. This isn't about getting lucky. It's about harnessing the mathematical certainty of diversification, low costs, and disciplined rebalancing. If you're ready to stop the frantic trading and start building real, lasting wealth with minutes of effort per year, this is your blueprint. Let's meet the 3 all-stars of this powerhouse portfolio. Each one is chosen for a specific, non-overlapping role that together creates a resilient, high-performing engine for your money. They are Vanguard Total Stock Market ETF, VTI, Vanguard Total International Stock ETF, VXUS, and Vanguard Total Bond Market ETF, BND. This trio provides instant, global, and dirt-cheap diversification across nearly every publicly traded stock and bond on the planet. First, VTI is our core, our foundation, and our engine for growth. When you buy VTI, you're not buying a slice of the market. You're buying the entire U.S. market in a single share. It holds over 3,500 companies, from tech giants like Apple and Microsoft to every small, innovative company you've never heard of. It's weighted by market capitalization, so your money is allocated proportionally to the size of each company, which is a passive, rules-based way to ensure you always own the winners of the future. Its expense ratio is a microscopic 0.03%. This means for every $10,000 you have invested, you pay just $3 per year in fees. This is critical because fees are a silent killer of wealth, and by keeping them near zero, every single dollar of return stays in your pocket, compounding over decades. Second, we have VXUS, our passport to global opportunity. The United States represents only about 60% of the global stock market. By investing solely in VTI, you are ignoring 40% of the world's economic potential and putting all your eggs in one geographical basket. VXUS fixes that. It holds over 8,500 companies across more than 40 developed and emerging markets. Think Nestlé in Switzerland, Toyota in Japan, Samsung in South Korea, and TSMC in Taiwan. Different economies grow at different times and under different conditions. When the U.S. market might be stagnant or declining, international markets could be thriving, and vice versa. This diversification smooths out your ride and provides access to growth you would otherwise miss. VXUS carries a slightly higher but still incredibly low expense ratio of 0.07%. Third, we bring in our anchor, BND, the Vanguard Total Bond Market ETF. While VTI and VXUS are for growth, BND is for stability and income. It holds over 10,000 U.S. bonds, including government treasuries, high-quality corporate bonds, and mortgage-backed securities. Bonds behave very differently from stocks. When stock markets crash due to economic fear, investors often flee to the safety of bonds, which can cause their prices to rise. This provides a crucial ballast for your portfolio. It reduces the gut-wrenching volatility that causes people to panic and sell at the worst possible time. Furthermore, BND pays a steady stream of interest income, which can be reinvested or used as a cash flow buffer. Its expense ratio is 0.03%. Now, the magic isn't just in picking these 3 funds, it's in how we combine them. The single most important decision you'll make is your asset allocation. What percentage goes into stocks, VTI and VXUS, and what percentage goes into bonds, BND. This ratio determines your portfolio's risk and return profile more than any other factor. For a long-term investor with a horizon of 10+ years and a tolerance for moderate volatility, a classic and proven allocation is 60% stocks/40% bonds. But we can refine this further for the modern global investor. I propose the following specific allocation for our 3 ETF portfolio, which I call the Global Balanced Anchor allocation. 45% to VTI, U.S. Total Stock Market, 15% to VXUS, International Total Stock Market, 40% to BND, U.S. Total Bond Market. Why these numbers? This gives you a total stock allocation of 60%, 45% US plus 15% international, but it tilts meaningfully towards the US market. Historically, the US market has been a strong performer with deep, liquid markets and a favorable regulatory environment. The 15% to international ensures meaningful exposure without overcomplicating things or taking on excessive currency or political risk. The 40% bond allocation is the anchor. It is substantial enough to genuinely cushion a stock market crash, providing stability and peace of mind, while still allowing for strong growth from the 60% stock portion. So, how does this simple three-fund portfolio actually perform? Let's talk about backtesting, looking at historical performance, while remembering the vital disclaimer that past performance does not guarantee future results. However, history is our best laboratory for understanding how different asset classes interact. Over the last 20-year period, through 2023, a portfolio with this 45-15-40 allocation would have delivered an average annual return of approximately 6.5% to 7.5%, depending on the specific time frame and rebalancing method. More importantly, let's compare it to the behavior of the average investor. Financial research firm Dalbar Incorporated conducts a famous annual study called the Quantitative Analysis of Investor Behavior. It consistently shows that the average equity investor underperforms a simple buy and hold index strategy by a staggering margin, often by 3 to 4% per year over decades. Why? Emotional decision-making. Buying after prices have soared out of greed and selling after crashes out of fear. Our 3 ETF portfolio automates away these emotions. The backtested data shows that this portfolio would have handily outperformed the Dalbar average investor return over nearly every rolling 10-year period. It likely wouldn't have beaten a 100% S&P 500 portfolio in the strongest bull markets, like the 2000s. But it would have captured a large portion of those gains while suffering dramatically less damage during the brutal bear markets of 2000 to 2002, 2008, and early 2022. This is the key. Consistent, good enough returns with less gut-wrenching risk often lead to higher real-world investor outcomes than chasing volatile, high returns. Psychology is everything. A portfolio that drops 30% might cause an investor to abandon ship. A portfolio that only drops 15% in the same crisis is something an investor can hold on to, allowing them to stay invested and recover fully. By surviving the downturns, you capture the eventual recoveries. This is how a boring 60-40 portfolio beats 90% of investors, not by being the flashiest rocket ship, but by being the most reliable and psychologically manageable vehicle for the long journey. Let's analyze the risk in concrete terms. The worst calendar year for a 100% S&P 500 portfolio in recent history was 2008, with a loss of about 37%. For our 45-15-40 portfolio, the worst year would have been significantly less painful, with a loss in the range of 20 to 25%. That is still difficult, but it is a survivable decline. The standard deviation, a measure of volatility, of this portfolio is roughly 1/3 lower than a 100% stock portfolio. The Sharpe ratio, which measures risk-adjusted return, how much return you get per unit of risk, is significantly higher for this balanced portfolio than for an all-stock portfolio. Now, the final piece of the system that makes this all work mechanically: rebalancing. This is the disciplined process of bringing your portfolio back to its target allocation. Over time, as your investments perform differently, your percentages will drift. For example, in a great year for stocks, your 45% VTI allocation might grow to 50%, while your 40% BND allocation might shrink to 35%. You now own more risky assets than you intended. Rebalancing forces you to do the emotionally counterintuitive but financially brilliant thing: sell high and buy low. You would sell some of the outperforming VTI, selling high, and use the proceeds to buy more of the underperforming BND, buying low. This systematically removes emotion and enforces a rhythm of profit-taking and bargain shopping. There are 2 simple rebalancing rules. 1, calendar-based. Pick one day a year, for example, your birthday, January 1st. On that day, check your allocations. If they are off by more than a few percentage points, sell and buy to get back to 45/15/40. 2. Threshold based. Whenever any single holding deviates by more than 5% from its target, for example, VTI moves above 50% or below 40%, you rebalance. For most investors, the annual calendar method is perfectly sufficient and simplest to remember. This entire process, from checking your statements to placing 2 trades, should take you less than 30 minutes per year. That's it. 30 minutes a year to manage a portfolio that outperforms the vast majority of people glued to their screens. Let's project what this looks like in real dollar terms. Assume a starting investment of $10,000 with annual contributions of $6,000, like maxing out an IRA, an average annual return of 7%, and annual rebalancing. After 10 years, your portfolio would be worth approximately $100,000. After 20 years, your portfolio would grow to about $280,000. After 30 years, you would be looking at a nest egg of over $650,000. And remember, this is from a strategy requiring almost no maintenance. The power comes from the contributions, the compounding, and the rebalancing, not from genius stock picks. The beauty of this 3 ETF portfolio is its universal adaptability. The 45-15-40 split is a perfect middle ground, balanced allocation, but you can adjust the dials based on your age and risk tolerance. Aggressive, young investor, 30-year time horizon. 63% VTI/27% VXUS/10% BND. 90% stocks/10% bonds. Conservative, retiree, focused on income/preservation, 25% VTI/10% VXUS/65% BND, 35% stocks/65% bonds. The relentless pursuit of market-beating returns is the grand illusion of modern investing. It's a siren song that lures individuals into a labyrinth of complex strategies, expensive products, and emotional decisions that statistically almost always lead to failure. Study after study confirms a brutal truth. The vast majority of professional fund managers fail to outperform their benchmark index over a 10-year period. For the individual investor, the results are even more dismal, with behavioral pitfalls, panic selling, greed buying, and overtrading eroding returns by several percentage points annually. In this context, victory is not defined by spectacular wins, but by avoiding catastrophic, self-inflicted losses. The real secret to joining the top tier of investors isn't about finding the next Tesla. It's about constructing a fortress of a portfolio that is psychologically manageable, economically efficient, and mechanically sound. This is the profound power of simplicity. By embracing a strategy that seems almost too basic, you systematically eliminate every major error that plagues the average investor. You are not playing their game. You are building a wealth machine on a foundation of academic evidence and behavioral discipline. And it starts with letting go of the need to be clever and embracing the power of being consistently, boringly right. To understand why a 3 ETF strategy is so potent, we must first diagnose why most portfolios fail. The first killer is cost. Every dollar paid in expense ratios, advisor fees, transaction commissions, and bid-ask spreads is a dollar that cannot compound for you over time. A 2% annual fee might sound trivial, but over 30 years, it can consume over 40% of your potential portfolio value. The second killer is concentration risk. Betting heavily on a single stock, a single sector, or a single country is not investing. It is speculation. For every investor who struck gold with a single tech stock, there are thousands who saw their wealth evaporate with companies like Enron, Lehman Brothers, or GE. The third and perhaps most insidious killer is behavioral bias. We are hardwired to follow the herd, to extrapolate recent trends indefinitely, and to feel the pain of loss twice as powerfully as the joy of gain. This leads to buying at market peaks when optimism is rampant and selling at market troughs when fear is paralyzing, a recipe for permanent capital destruction. The 3 ETF portfolio is the antidote to all 3 poisons. It is engineered for cost efficiency, holding funds with expense ratios so low they are virtually negligible. It is engineered for diversification, owning such a broad swath of the global market that the failure of any single company, industry, or even country cannot derail your long-term plan. Most importantly, it is engineered for behavioral success. Its simplicity makes it easy to understand and trust. Its periodic rebalancing mechanism creates a systematic, rules-based process that forces you to act against your emotions, selling a bit of what is done well to buy more of what has lagged. This transforms investing from an emotional roller coaster into a dull administrative task, which is exactly what it should be. The goal is not excitement, the goal is financial freedom, and freedom is best built through quiet, consistent, and unremarkable steps. This philosophy is championed by some of the greatest financial minds in history. Jack Bogle, founder of Vanguard, built an empire on the premise that simplicity is the master key to financial success. Nobel laureate Harry Markowitz's modern portfolio theory demonstrates that diversification is the only true free lunch in finance. You can reduce risk without necessarily reducing expected returns. Our 3 ETF portfolio is the direct, practical application of these foundational ideas. It represents the culmination of decades of financial science distilled into a strategy so straightforward that anyone can implement it. It requires no forecasting, no stock analysis, and no timing of the market. It requires only the discipline to set it up, fund it consistently, and rebalance it periodically. In a world flooded with conflicting advice and complex products, this elegant simplicity is not a weakness. It is its ultimate strength. Before we even name the 3 funds, it's critical to set the right expectation. This portfolio will never be the top performer in any given year. During a raging bull market focused on U.S. tech stocks, portfolios heavy on NASDAQ index funds will leave it in the dust. That is not its purpose. Its purpose is to be a long-term wealth compounder that delivers very good returns with significantly less volatility and heartache. It is designed for the marathon, not the sprint. By smoothing out the ride, it dramatically increases the likelihood that you, the investor, will actually stay invested through the inevitable storms. The history of markets is written by those who remained seated. This portfolio is your comfortable, durable seat for a lifetime journey. It removes you from the day-to-day drama of financial news and aligns your capital with the long-term upward trend of global economic progress. You are not betting on a story. You are owning a stake in human ingenuity and productivity itself, packaged in its most efficient and reliable form. The framework remains identical. You simply change the percentages in the same 3 funds. As you age, you might gradually shift from the aggressive mix toward the balanced and finally to the conservative mix, a strategy known as a glide path. In a world of infinite financial complexity, overwhelming choice, and constant noise, the greatest advantage you can give yourself is simplicity. The 3 ETF portfolio of VTI, VXUS, and BND provides that. It gives you global diversification, near-zero costs, automatic rebalancing bonuses, and a structure that keeps your emotions in check. It won't make for exciting cocktail party talk, but it will make you wealthier than almost everyone else at the party. Stop trying to beat the market. Start owning all of it, simply, cheaply, and forever. This is the portfolio that does the work for you, so you can get back to living your life.
Now let's step into something that's a little more under the radar. SVOL, the Simplify Volatility Premium ETF. This one's genius in its simplicity. Instead of stocks or bonds, SVOL sells short volatility through VIX futures. Basically, it profits from calm markets as volatility decays. By capturing that premium, SVOL distributes a steady 15 to 18% yield. What's impressive here is that it's built with a hedge. It actually buys out-of-the-money VIX calls to protect against spikes in volatility, meaning you don't get wiped out during a market panic. Funds like SVOL have quietly been outperforming traditional income funds because they generate cash from market behavior itself. The 4th ETF that's making serious waves is RSPY, a synthetic high-yield ETF built to mimic a risk parity strategy. It blends stocks, bonds, commodities, and derivatives to maintain balance while optimizing for yield. On paper, it doesn't look flashy, but it's been quietly distributing around 16 to 20% in yield, without decay seen in leveraged ETFs. How? Because it constantly rebalances, trimming risk when markets overheat and adding exposure when volatility cools. Think of it as the disciplined income investor's dream. You're getting a high payout while the fund manages drawdowns for you. RYLD, the Global X Russell 2000 Cover-to-Call ETF, targets small-cap stocks, offering higher volatility and premiums. RYLD delivers around 15 to 18% annualized yield with monthly distributions, reliable income despite market downturns. Pair RYLD with JEPI or SVOL for a balanced portfolio balancing stability and aggressive growth. Allocate strategically: 25% JP, 25% QYLD, 25% SVOL, 25% RYLD, for an average yield of 18 to 20%. On a $100,000 portfolio, expect $1,500 to $1,700 monthly income. Scale to $1 million for over $17,000. Unlike volatile assets, these ETFs provide real, steady cash flow. Even the best high-yield ETFs can suffer if you don't reinvest or manage your risk. Income investing isn't about chasing the highest number. Look at distribution sustainability. Is the yield based on real earnings or just return of capital? Track NAV stability. Most investors are wired for growth, not income. They want big stock stories, not quiet compounding of dividends. Wealthy investors understand the power of cash flow. Predictable, passive income gives you freedom. Many of these ETFs pay qualified dividends, taxed at lower rates, adding more money to your pocket. Pair with a tax-advantaged account, like an IRA, to maximize your compounding even more. Diversification is key. Don't go all in on one strategy. Mix high-yield ETFs with core holdings like bond ETFs or dividend aristocrats. Think of your high-yield ETFs as your cash flow engine. They generate the income for reinvestments, lifestyle, or long-term growth. Track your yield on cost. Over time, as you reinvest, your effective yield grows, even if the fund's yield percentage stays the same. The market has its skeptics. Some say high-yield ETFs are ticking time bombs. The truth is, smart investors manage and rotate effectively. With high-yield ETFs, your assets send you checks monthly. That's real financial independence. Income independent of your boss or market euphoria. Imagine waking up on the first of every month to find $1,400 deposited automatically in your brokerage account. No stress, just passive income. Dream of replacing your paycheck with passive income? This is the strategy that gets you there faster than you think. It's not about luck or gambling. It's about structure, research, and discipline. Focus on ETFs with sustainable yield models, low NAV decay, strong management, and monthly distributions. Examples include JEPI, QYLD, RYLD, SVOL. Combine these ETFs intelligently and protect your downside. You're not just building a portfolio, you're building freedom. At the end of the day, this game is about freedom. Your money should work harder than you do. The psychology behind income investing is often overlooked. It's not just about financial freedom and passive income, but a mental journey. Income investing requires discipline, patience, and a long-term mindset. It's not about chasing the latest trend. Building an ETF income portfolio is slow and steady. It doesn't give you that instant dopamine hit like day trading. Most investors fail not from bad investments, but from quitting too soon. They forget that dividends stack invisibly. Wealth grows in invisible layers, brick by brick, through monthly distributions and reinvested shares. The impatient investor misses this. The smart investor sees beyond a flat chart. Hope for success is different from building it. Emotional control is worth more than financial IQ in this game. Markets dip, and you might hear, "Sell now before it gets worse." Those dips are when your yield spikes. Stay calm and reinvest when others panic to lock in higher returns for life. The same $1,000 dividend that bought 50 shares last month might buy 70 this month if prices drop. That's leverage disguised as opportunity. One of the biggest mistakes is chasing yield blindly. A 25% dividend can be tempting, but not all yield is created equal. Some yield is pure return of capital, meaning the fund is paying you back your own money. That's not income. Always check the fund's distribution breakdown. If over 40 to 50% are ROC, ask why. It might not generate enough cash to sustain payouts. The second big mistake? Ignoring NAV decay. High-yield ETFs like QYLD or RYLD can seem like they're losing money, but that's not the whole story. These funds trade upside for income. When you consider distributions, your total return may surpass traditional equity ETFs. If your aim is income, price stability is crucial. Expecting growth like Tesla from a high-yield ETF leads to disappointment. The third mistake? Lack of diversification across yield types. Relying on one strategy can hinder returns in a rally. Mixing yield mechanisms is smarter. Using JEPI, SVOL, XYLD, or DEVO can stabilize returns in different market conditions. Think of it as an orchestra of income. Each plays a role, but together they create harmony. Let's say your portfolio pays $2,000 a month in dividends. You could withdraw that, but what if you reinvested just half of it? That $1,000 monthly reinvestment means you're buying more income every month. Over time, your future payouts increase exponentially. After 2 or 3 years, your reinvested income alone might cover your living expenses. That's when you cross into financial independence. Now let's talk about risk management. High-yield strategies aren't magic. They carry exposure to volatility and market shocks. The secret isn't avoiding risk, it's managing it smartly. One strategy I love is rotational rebalancing every few months. Trim a bit from the top performer, add to the laggard, and rebalance your weights. This forces you to sell high and buy low. Another strategy? Setting a dividend buffer. Save 10 to 15% of your income in cash or a money market fund. When markets correct, you can use that buffer to buy more shares at discounted prices, compounding your yield on cost. One of the smartest things you can do is hold your high-yield ETFs inside a tax-advantaged account like a Roth IRA or 401k. Focus on funds with tax-efficient structures that generate option premium income classified as capital gains, not ordinary income. Document your income journey. Every month, record how much our portfolio paid you. Watch it grow. Seeing those numbers move can change your mindset. Passive income isn't just a fantasy. It's real and measurable. This system works even better when markets are uncertain. Experienced investors welcome red markets. Cash flow continues. Imagine not just building income for yourself, but building a legacy. Every reinvested dividend becomes an asset that outlives you. Someday, someone you love could inherit a machine that keeps printing money. That's what real wealth looks like. Freedom that passes on. There will be months when your ETFs drop in price and you'll question everything. That's when discipline matters most. Understand the fundamentals. Your income is still flowing. Your yields are still compounding. Short-term fluctuations won't scare you. Start small, but start now. Don't wait for the right market. Be consistent. Every month you delay is a month you could have compounded. Even $100 invested today can start that snowball rolling. The key is consistency, not perfection. When you see those deposits hitting your account every month, you realize you're no longer working for money. Your money's working for you. That's one of the most liberating feelings in the world. Research these ETFs, understand their structure, look at their distribution history, and build a mix that suits your risk tolerance. Don't copy blindly. Customize intelligently. Start tracking your income, reinvest regularly, and protect your capital like a pro. Do this consistently for a year, and I promise you'll look back and wonder why you didn't start sooner. This isn't just about numbers. It's about freedom. The freedom to choose how you live, where you live, and what you do with your time. If you found this breakdown valuable, hit that like button, subscribe, and share this with someone still chasing hype instead of building freedom. Build your system, make your portfolio your paycheck, and let compounding take care of the rest. Most people spend their lives chasing paychecks, but never build systems that pay them. Imagine every first week of the month, Jeppy hits your account with dividends. A week later, RYLD follows, and a few days after that, you get a payout from Devo. It's like your portfolio has its own payroll calendar. Every month, you're getting paid by the market, not your boss. That's what true financial rhythm feels like. One viewer commented, "I started small, just $200 a month in JEPI. A year later, I'm getting $36 in dividends each month. It's not much, but it's a start. You don't need thousands to begin. You just need the mindset to start." Once you see those first deposits, something clicks. It's proof your money can grow and give back, quietly and consistently. When you wake up and realize your portfolio covered your rent, you'll understand what real financial freedom feels like. It's not about yachts or private jets. It's about peace. It's about knowing your future is funded. Stay patient, stay disciplined, and keep that compounding engine running. The markets will swing, but your income will keep rolling in. If this breakdown helped you see ETFs in a new light, hit that like button and share this video. Next week, I'm breaking down how to build a 3-fund portfolio that can outperform 90% of retail investors. You've probably seen those jaw-dropping dividend yields, 20%, 25%, even 30%. And you've thought, there's no way that's real, right? Every time you've looked into high-yield options, there's always a catch. The share price falls faster than dividends come in. But what if I told you there are ETFs paying between 15% and 33% annualized yields without eroding your portfolio? Today, we're diving into 5 ETFs that are quietly turning monthly income into a wealth engine for investors. High-yield investing is not a get-rich-quick strategy. It's a cash flow strategy anchored in understanding risks and sustainability. A 20% yield means nothing if your fund drops 30% every year. Balance is key for serious income. Let's start with JEPI, the JP Morgan Equity Premium Income ETF. A cult favorite, it pays around 10 to 12% annual yield, distributed monthly. Managed by a respected financial institution, JEPI uses a covered call strategy, owning large-cap U.S. stocks and selling options to generate income. Thanks to its blue-chip stock holdings, JEP offers less price volatility, providing more stability compared to pure option-based funds. Next is QYLD, the Global X Nasdaq 100 Covered Call ETF. This ETF is a bit more aggressive, focusing on major tech companies. QYLD writes covered calls on the Nasdaq 100, generating around 12 to 15% yield, but capping upside gains during market rallies. In flat or down markets, QYLD shines, providing income while others wait for price appreciation, turning stagnation into opportunity. Today, we're diving deep into the best dividend ETFs you need to know. Dividends are powerful, like getting paid to own stocks. If you've ever wondered how to build wealth passively, dividend ETFs are a game changer. We'll break down 5 of the best options. ETFs are baskets of stocks or assets that trade on the stock exchange, just like a single stock. Dividend ETFs focus on companies with consistent dividends. You get exposure to multiple companies, reducing risk while earning payouts that can compound over time. It's a proven strategy. Being patient and consistent with dividend investing can lead to steadily growing wealth. The first ETF is a favorite among dividend-focused investors, a fund targeting high-quality, dividend-paying U.S. companies. Think of it as the foundation of your portfolio. These funds typically include giants in technology, consumer staples, utilities, and healthcare. Examples include Johnson & Johnson, Procter & Gamble, and Microsoft. The advantage is stability. These aren't speculative stocks. They're established businesses with long histories of paying dividends. Next up, we have ETFs focusing on high-yield dividends for those looking to maximize income. These include companies with above-average dividend payouts. Sectors like real estate, energy, or telecommunications typically feature these companies. The appeal is clear: more dividends, more cash flow. However, higher yields often come with higher risk, so it's essential to balance these with more conservative dividend funds. Many savvy investors mix high-yield ETFs with core dividend funds to capture income without excessive risk, especially if reinvesting dividends. International dividend ETFs invest in companies across Europe, Asia, and other emerging markets. They provide global exposure and diversification. These ETFs give you access to global giants and industries not available in a US-only portfolio. It's a great way to diversify. Keep in mind, currency fluctuations and geopolitical risks can affect returns, but they help balance your risk and offer growth opportunities. Another category to consider is dividend growth ETFs. They target companies that consistently raise dividends over time. Dividends are important. Companies like Apple, PepsiCo, and Visa often appear in these ETFs, reflecting strong financial performance. Dividend growth offers a dual advantage of income and portfolio appreciation, significantly outperforming simple, high-yield strategies over time. These funds focus on industries known for steady dividend payouts, such as utilities, consumer staples, or healthcare. By targeting these sectors, investors can fine-tune their income strategy based on their risk tolerance and market outlook. Utilities, for instance, provide consistent dividends even in downturns because people need electricity and water. It's vital to avoid over-concentration. Sector-specific ETFs work best as complements to broader dividend ETFs. If you invest $10,000 in a core dividend ETF yielding 3% annually, that's $300 in dividends each year. Now imagine adding a high-yield ETF with a 5% payout. Your income jumps to $500 annually from that part alone. Over a decade or two, these strategies can transform a modest investment into a substantial income-generating machine. Don't put all your eggs in one basket. A balanced dividend ETF portfolio might include a core U.S. dividend fund, a high-yield fund, and more. By combining these, you spread risk across companies, sectors, and regions. If one area underperforms, the others can compensate. Remember, dividend investing is about consistency over time, not chasing short-term gains. Patience and discipline are your best allies. Pay attention to fees. ETF expense ratios vary, and even a small difference can add up over time. Look for ETFs under 0.5%. Tax efficiency is also a factor. Be aware of tax implications helps you plan smarter. Small differences can compound over the years. Dividend reinvestment plans, or DRIPs, allow you to automatically reinvest dividends into more shares of the ETF, creating a snowball effect. This accelerates wealth growth as your dividends earn more dividends. Many brokers offer DRIPs with no additional fees. The key here is consistency. The earlier and more consistently you reinvest, the greater the compounding impact. Investors worry about dividend cuts due to economic downturns or company struggles, making diversified ETFs essential. While a single company might cut dividends, diversified ETFs cushion the impact across many holdings, helping you stay calm. Dividend ETFs aren't just for retirees. They can supplement portfolios, provide cash flow, and reduce volatility. Younger investors can use dividend ETFs as growth components while building passive income streams early. Dividend investing is less about timing the market and more about staying invested over the long term. Regular contributions, whether markets are up or down, create a compounding effect that smooths out market cycles. Consistency beats trying to predict market tops and bottoms. Economic cycles affect dividend-paying companies. Utilities and consumer staples tend to be more resilient in downturns. By holding diversified dividend ETFs, investors balance exposure across sectors that react differently. Dividend investors often develop patience and discipline. Receiving regular payouts reinforces the value of long-term investing. Watching dividends grow over time provides both psychological and financial rewards. Technology and online tools make dividend investing easier than ever. You can track ETF performance, set up automatic contributions, and monitor dividend schedules. Many investors use alerts to stay informed about dividend changes, payouts, and market news. Technology streamlines portfolio management. Imagine combining a broad U.S. dividend ETF, a high-yield ETF, an international dividend ETF, and a dividend growth ETF. Your portfolio spreads across hundreds of companies. Each quarter, you receive dividends that are reinvested automatically, compounding steadily over time for income and portfolio growth. Investors should remember that past performance is not a guarantee of future results. Market conditions change, but core principles remain sound. Combining strategies with ongoing learning and portfolio review positions investors to maximize returns over time. It's important to periodically rebalance your dividend ETF portfolio to maintain your intended allocation and risk profile. If high-yield ETFs outperform and take up a larger portion, trimming shares and reallocating to core or international ETFs helps maintain balance. Many investors combine dividend ETFs with other income strategies, like bonds or real estate, to diversify. Bonds provide fixed income, while dividend ETFs add equity exposure, reducing overall portfolio volatility. Sustainable and ESG dividend ETFs focus on companies with strong governance practices while providing income, aligning ethics with finances. Behavioral discipline remains critical. The temptation to chase higher yields can erode long-term results. Dividend ETFs can serve as a hedge against inflation. They offer pricing power and the ability to grow earnings. This growth leads to higher dividends, helping maintain real purchasing power in your portfolio. Watching dividends accumulate reinforces disciplined investing habits. Regular payouts keep investors engaged. Dividend ETFs can be passed on to heirs, providing ongoing income while maintaining equity exposure. One of the often overlooked benefits of dividend ETFs is their versatility across different market conditions. Unlike growth-focused ETFs, dividend ETFs provide a steady stream of income regardless of market volatility. This consistency is valuable during recessions. Investors who rely solely on capital appreciation often feel pressured to sell. With dividend ETFs, the dividends continue to flow, offering a source of reassurance and stability. Another key factor is sector diversification within dividend ETFs, reducing exposure to sector-specific risks. Tax efficiency is another crucial advantage. Qualified dividends are taxed at a lower rate than ordinary income, making dividend ETFs more attractive. Some dividend ETFs are structured to minimize capital gains distributions, further enhancing tax efficiency. This can mean keeping more money working for you. The compounding effect of reinvested dividends coupled with tax efficiency can significantly amplify overall returns over decades. Automatic dividend reinvestment plans, DRIPs, allow investors to purchase additional shares with earned dividends, compounding wealth over time. Small, consistent reinvestments can grow into substantial holdings. An investor could potentially double or triple their portfolio in 15 to 20 years. The long-term effect of compounding, especially with growing dividends, is a powerful wealth-building mechanism for everyday investors. Dividend ETFs can act as a buffer against inflation. Companies that consistently increase dividends often have strong pricing power, passing cost increases to consumers. This pricing power allows dividends to grow over time, maintaining real purchasing power. For example, if a dividend ETF yields 4% today and dividends grow by 5%, the real yield protects income. This makes dividend ETFs especially attractive in inflationary environments, where traditional fixed income products like bonds may fail to keep pace with rising costs. Another significant factor is global reach. Some ETFs focus on U.S. companies, while others provide exposure to international dividend payers. This global exposure allows investors to capture opportunities in emerging markets, Europe, and Asia, offering higher yields due to differing corporate practices. The presence of dividends provides a tangible reward, even when stock prices are temporarily falling. Receiving regular dividend payments helps investors psychologically separate income from market price fluctuations. This emotional benefit is particularly valuable for younger investors who may face market volatility over multiple cycles. Dividend ETFs encourage patience and discipline, traits that are statistically correlated with superior long-term investment performance. For income-focused investors, dividend ETFs offer a reliable alternative to bonds, especially in a low-interest rate environment. Dividend ETFs provide exposure to equity income, often outperforming bond yields over long periods, while offering potential for capital appreciation. The combination of income and growth makes dividend ETFs a hybrid solution, blending the stability of fixed income with the upside of equities. Long-term investors should consider the compounding effect of dividend growth. Companies that consistently raise dividends exhibit strong fundamentals. Dividend growth ETFs aggregate these companies, creating a self-reinforcing ecosystem. As dividends grow, reinvested dividends buy more shares, generating even more dividends. Modest dividend growth rates of 5 to 6% per year can substantially increase portfolio value and generate a reliable income stream in retirement. Dividend ETFs reduce the temptation to chase speculative growth stocks and typically include mature, cash-rich companies. In periods of market uncertainty, these ETFs often experience less volatility, offering both income and relative stability. Pension funds and endowments allocate to dividend-focused strategies, combining yield with relative safety. This recognition adds credibility to dividend ETFs, making them a core component of a well-structured, long-term portfolio. Dividend ETFs benefit from economies of scale and efficient management, reducing costs for investors through lower expense ratios. Unlike mutual funds, ETFs offer liquidity and transparency, allowing investors to buy and sell shares throughout the trading day. This combination makes dividend ETFs accessible for investors at all levels, from beginners to seasoned professionals. Dividend income provides predictable cash flow for retirees who want to avoid tapping into their principal. Reinvesting dividends can compound wealth, creating a larger retirement nest egg over decades. Look for ETFs that emphasize quality, companies with low payout ratios, consistent earnings, and strong balance sheets. These factors increase the likelihood that dividends will continue growing even during economic downturns. Technological advancements and automation have enhanced dividend ETF performance, optimizing selection and monitoring. Robo-advisors, algorithmic trading, and AI-driven analysis allow investors to efficiently reinvest dividends. These tools democratize access to portfolio management, giving retail investors a competitive edge. Dividend ETFs now align with socially responsible and ESG-focused strategies, meeting investor values. Dividend ETFs provide stability, growth, and compounding power for long-term wealth and reliable income. If you found this breakdown helpful, hit the like button, subscribe for more insights, and share your thoughts. There's a new name about to crash the high-income ETF party, and it's called TAC, short for Tap Alpha TDAC ETF. Most people haven't heard of it, but once you see what this fund is doing differently, you might rethink your current ETFs. I'm not just talking about a decent performer. This fund is built on a model that's proven itself with real, sustainable yield. CAC aims for consistent, high monthly income without self-destruction. It keeps rewarding you year after year. This isn't just a product launched by a giant institution. This is Tap Alpha, the team behind T-SPY that's been successful in the S&P 500. These guys aren't gamblers. They understand yield like science, not a lottery. TAC's whole foundation revolves around something called zero DTE options. That's 0 days to expiration. It sounds complicated, but the idea is simple and brilliant. Instead of writing options that last a week or a month, TAC writes them daily, capturing small bursts of income from short-term market volatility. Every single trading day, it resets. No baggage, no long-dated risk hanging over it. It's kind of like a fisherman casting his net every morning instead of once a week. The more throws you get, the more chances to catch premium. Now, Cure. The expense ratio sits at 0.68%. Some might see that and raise an eyebrow. In the high-income ETF space, that's actually reasonable, especially when you realize this fund isn't passive. It's active, tactical, and constantly adjusting to market conditions. You're paying for brains, not bureaucracy. And those brains? They belong to Tap Alpha, a team that's already proven their approach works. Their first breakout hit, T-SPY, uses the same zero DTE concept, but with the S&P 500 instead of the NASDAQ 100. That fund has already outperformed plenty of bigger, flashier names, all while maintaining steady yield and solid NAV control. KDAC, or TAC, is basically the wilder sibling. Instead of the S&P 500's calm, it's tapping into the NASDAQ 100's faster heartbeat. If you know anything about volatility, more movement means more premium potential. It's like surfing. Bigger waves, bigger payoffs. But don't mistake this for a reckless thrill ride. TAC's approach isn't about chasing explosive gains. It's capturing opportunity with precision. The NASDAQ is home to giants like Apple, Microsoft, and Nvidia. Their volatility isn't chaos, it's energy. Let's be real. Chasing sky-high yields often leads to losses. It's like taking cash from your savings and calling it profit. TAC's goal isn't absurd yields. It balances real income with long-term capital discipline, avoiding the trap of financial cannibalism. Tap Alpha's track record with T-SPY is impressive. It started outperforming established names. Not just a lucky streak, it was a signal. They found a formula that actually works, and now they're applying it to the faster environment of the NASDAQ. If T-SPY holds up in the calm waters of the S&P 500, TAC is moving into a faster current with more potential. Innovation matters in this space. Many ETFs today are just clones, but Tap Alpha's approach feels different. They're not chasing the highest yield. They're focused on the smartest yield. a significant difference. Very few can sustain 12 to 15% returns for years. TAP Alpha is committed to balancing income and capital health. We've all seen funds implode, flashy ones promising monthly income. TAC's model adapts, built on disciplined premium collection and daily resets. Adaptability is key. Markets change daily. TAC's zero DTE structure allows for immediate adjustments, unlike traditional holdings. Time decay in options is crucial. TAC captures premium in the final hours before expiration, effectively maximizing profits. It's not magic. It requires skill, risk management, and a dedicated team. TAP Alpha proves it can outperform faceless ETFs. I'm bullish on TAC. Like T-SPY, it boasts real yield and performance, with even greater potential due to Nasdaq's volatility premium. 2026 could be the year this ETF steps out of the shadows and takes a seat at the grown-up table, next to NEOS, YieldMax, and the big players. TAC feels different from the high-income ETF crowd. The field is packed with imitators, all trying to be the next JEPI or NEOS. TAP Alpha didn't show up to copy anyone. They're rewriting the rulebook with real, juicy yields. They don't chase every ounce of premium if it risks long-term damage. Steady income and base protection is key. TAC structure adapts daily, capturing short-term volatility in the Nasdaq 100 and converting it into distributable income. TAC is an income fund, not a growth rocket. It's not trying to compete with QQQ or tech-heavy momentum plays. If you're chasing 5 times capital gains, this isn't your lane. But if you want monthly distributions that can fund real life, then TAC makes sense. The Nasdaq 100 is concentrated with just 100 companies, mostly tech or growth focused. This leads to sharper moves and bigger volatility swings. With TAC, volatility isn't a threat, it's an opportunity. Higher volatility increases option premiums, which TAC takes advantage of daily. Unlike old-school covered call ETFs, TAC adjusts every trading day, ensuring it reacts to the market rather than enduring it. In unpredictable markets, reactivity is crucial. TAC wakes up daily, scans the Nasdaq, and recalibrates positions to maintain agility. TAP Alpha's T-SPY has proven its mettle, consistently delivering results while writing short-dated options daily. T-SPY has outperformed established funds, even those backed by big institutions and massive budgets. In the past year, T-SPY's total returns have surpassed 16%, outperforming JEPI and matching NEOS and GPIX. With the S&P 500 stability achieved, imagine T-SPY in the more dynamic Nasdaq environment. Higher volatility does mean higher risk, but with proper management, risk can be a partner in success. TAP Alpha emphasizes discipline, steering clear of reckless funds that flash unsustainable high yields. And honestly, that's refreshing. This space is full of noise, flashy tickers, overpromises, and under-delivered results. TAP Alpha feels almost old school in their honesty. Their focus isn't look how high our yield is, it's look how long we can keep paying it. If you dig into the competition, funds like NEOS, YieldMax, Defiance, Roundhill, you'll notice a pattern. NEOS focuses on tax-efficient call writing, YieldMax on hyper-yield plays, Roundhill with thematic exposure. TAP Alpha found their own lane. Daily precision. They're stacking singles, day after day, and it's working. Another thing I respect, transparency. Tap Alpha doesn't hide behind vague marketing. They're just saying, here's how we turn volatility into cash. Simple, direct, believable. When T-Spy hit $50 million in assets, they said they'd launch their next fund. A lot of companies talk a big game. These guys actually did it. TAC charges a 0.68% expense ratio. It's not the cheapest, but in this category, cheap isn't always better. You get what you pay for, especially with active management. TAC isn't passive. It's not on autopilot. Every trading day, a real team is recalibrating and rebalancing to maximize NASDAQ returns while controlling drawdowns. High-income ETFs balance yield and capital health. If you chase yield too hard, you destroy NAV. If you protect NAV, your income shrinks. The art is in the middle. Tap Alpha adjusts balance like a pilot through turbulence. Too high, you lose speed. Too low, you risk a crash. Constant correction is key. Zero DTE trading gives flexibility. We're heading into a market where flexibility matters. Funds that adapt daily will win. Looking ahead to 2026, I see TAC as a modern, adaptable income ETF. You can pair TAC with T-Spy and create something special. One feeds off the S&P 500 steadiness. The other thrives on NASDAQ's volatility. Together, they balance each other out beautifully. It's like having one foot on solid ground and the other on a wave. Stability and momentum. You could split it evenly or lean heavier toward whichever index you're more confident in. That's a powerful combo for investors chasing monthly income without feeling like they're lighting their capital on fire. When a fund's model keeps working across different markets, that's not luck, that's engineering. And that's what Tap Alpha's proving. T-Spy has shown resilience through rate hikes, rallies, and pullbacks. It's not just about eye-catching yields, it's preserving value. That's why TAC is gaining attention, taking a proven structure and integrating it into the NASDAQ 100. The NASDAQ is unpredictable in a great way, jumping 2% in a week or tumbling overnight. Ideal for an options-based income fund. Every swing offers a chance to harvest a premium. The faster the market moves, the more fuel TAC has to work with. Tap Alpha isn't loud about their results. No flashy ads or Super Bowl airtime. Just quiet, efficient performance. Tap Alpha's leadership focuses on data and performance rather than hype. Results speak for themselves. What sets TAC apart is adaptability. In volatility, others freeze. TAC thrives. Income shifts with the market. TAC does carry risk, particularly since it's based on NASDAQ 100. But for those valuing cash flow, the risk-to-reward ratio is appealing. TAC is competing with the best in the business: Neos, YieldMax, JEPI, and Defiance. It's nipping at their heels in total returns. On a pure price basis, funds like GPIX may lead, but factoring in total return with reinvested distributions, T-Spy climbs to the top. T-Spy has some of the strongest total returns in the high-income ETF arena, consistently outperforming major funds. Those 40% yield ETFs seem attractive, but often reveal crumbling NAV behind the scenes. You're not making real gains. TAC offers steady, meaningful income that you can depend on, unlike many flashy options out there. If you're building a portfolio for consistent monthly income, TAC deserves a spot on your watch list. Pair it with T-Spy and you've got a killer combo. Two funds covering very different market personalities. One gives you the stability of the S&P 500, while the other gives you the velocity of the NASDAQ 100. Imagine collecting distributions from both, diversifying your yield streams without overcomplicating your portfolio. To track performance, go on platforms like Seeking Alpha, check the comparison tools, and see the data for yourself. Funds like T-SPY are outpacing bigger names that spend 100 times more on marketing. TAC checks all the boxes for a market that's fast, unpredictable, and rich with volatility. There are 3 reasons I'm betting big on TAC for 2026. First, its strategy, built around daily, zero DTE premium harvesting. It's modern, nimble, and engineered for efficiency. Second, its proven lineage, the exact same framework that made T-SPY one of the best performing income ETFs of the past year. Third, its leadership, a team that has earned trust not by marketing hype, but by results. TAC isn't just another ticker. It's the next evolution of income ETFs, disciplined, forward-thinking, and perfectly timed for the next phase of the market. If you learned something here, hit that like button, share this with a friend, and drop your thoughts in the comments.